6 figures, still broke. That's not irony, that's 60% of Americans. More money. Same zero. The income went up, the savings rate didn't. The salary doubled, the net worth didn't move. That gap has a name. Lifestyle inflation. It's polite, it's invisible, it's lethal to wealth. Two people, same salary. 20 years later, one is free, one is trapped. Alex earns $90,000, spends $88,000, saves $2,000 a year. Jordan earns the same $90,000, spends $60,000, invests $30,000. Same job, same city, completely different financial destinies. That delta, what you make minus what you spend, is everything. Not your salary, not your bonus. The gap is your actual financial engine. The Federal Reserve confirms it. High earners, low savers, everywhere. 60% of six-figure earners paycheck to paycheck. Read that again. The problem is not income. Never was. It's the system around income. Build the system first. The income fills it, not the other way around. 9 milestones. 1 framework. Real numbers. Let's go. I've tracked every expense since 2014. Every dollar. No exceptions. A decade of data changes how you see money. Everything gets clearer. You can't optimize what you don't measure. That's not philosophy. It's math. 5 years ago, my Roth IRA had $29,800. Today, it's past $100,000. Tax-free. That number compounds forever. The IRS lets you put in $7,000 per year under 50. $7,000 a year at 10% average returns since 30. Watch this. $1.2 million. Tax-free. By 65. That's the Roth math. Most people know about Roth IRAs. Almost nobody actually maxes one out. Knowing is not doing. The gap between those two is where wealth dies. Maxing your Roth IRA is not a goal. It should be a non-negotiable habit. Automate it. Payday hits, $7,000 divided by 12 goes in. Done. You earn over $168,000? The backdoor Roth is your door. Contribute to a traditional IRA, then convert. Legal, effective, underused. Every year you don't max it, that compounding slot disappears. Forever. The Roth IRA income limit in 2026 for individuals is $168,000. For joint filers, it's $252,000. Check your number now. VOO and VTI averaged over 10% annually for the last 30 years. Inside a Roth, those returns are entirely, permanently, legally tax-free. That's the most powerful investing account in the American tax code. Period. Milestone 1 isn't complex. Max it every year. Automate it. Never stop. Milestone 2 is harder. It requires you to fight your own psychology every day. The millionaire next door showed it clearly. Wealth and lifestyle don't scale together. The best accumulators of wealth keep their lifestyles cheap while income climbs. Lifestyle inflation is a silent tax. It takes everything before you notice. I've tracked expenses since 2014. Income grew. Lifestyle barely moved, intentionally. The delta is your weapon. Guard it like it pays your retirement. Because it does. Alex's lifestyle crept up each raise. Jordan's didn't. Same starting point. 10 years later, Jordan's net worth is 11 times Alex's. Same salary. Always. And the emergency fund? That's where things get really uncomfortable. Stay with me. 3 to 6 months emergency fund. That's what everyone says. It's not enough. 12 months of expenses. That's my target. Mental freedom costs more than you think. High-yield savings accounts currently pay 3 to 3.5%. Use them. Your emergency fund should earn something while it waits. Every basis point matters. Start smaller. $1,000 first, then $2,000, then $5,000. Build it. Without 12 months of cushion, every financial decision is made from fear, not logic. Fear-based financial decisions cost more than any market crash ever could. Your income is not your wealth. Your savings rate is. Write that down. Now we get to the milestone most people skip completely. Estate planning. No estate plan, someone you love faces a nightmare you could have prevented. A living will. A healthcare power of attorney. Two documents that protect everything. Even a wooden trailer with a title can become a legal nightmare without a plan. Alex never made a will. Jordan did at 32. This matters more later. If you have dependents or assets, you need an estate plan. Age is irrelevant. Estate planning is not morbid. It is the most loving financial thing you can do. Now, income. 95% from one source is not a strategy. It is a vulnerability. 5% from dividends. Goal: grow that number before the primary source disappears. SCHD has a historically consistent dividend yield of around 3 to 4% annually. 100,000 in SCHD generates 3 to 4,000 in annual passive dividends. An extra 500 to 1,000 per month changes everything. Psychologically. Rental income. A side business. Freelance work. Pick one and build it slowly. You do not need 5 income streams. One additional stream changes your risk profile completely. Jordan built a small rental income stream at 34. Alex never did. Watch this. By 40, Jordan's second income covered 30% of monthly expenses. Alex's, 0. The best investment account isn't the one with the highest return. It's the one you fund. Now the housing question. Bay Area renting can be cheaper than ownership. Do the math. At 6.5% mortgage rates, ownership math is brutal. Run the numbers first. A $500,000 home at 6.5% costs $940,000 total. But buying has psychological value, stability, customization, a fixed monthly cost. Don't let the financial argument alone decide. Factor in what stability is worth to you. Health is a financial milestone. Bad health is the most expensive thing you can own. Better health buys you more productive working years. That converts directly into wealth. The SSA projects that a 40-year-old today lives to 84 on average. Plan for it. Hit subscribe. The algorithm buries this, and most people never find it. In a few scenes, I'll show you the number that breaks everything you just learned. But first, a 1% annual fee on $200,000. Sounds tiny. It isn't. Over 30 years, that 1% fee costs you $170,000. VOO has an expense ratio of 0.03%. That's the standard. Demand it. The difference between 0.03 and 1% is not small. It is your retirement. Compound interest is not a math concept. It is a boulder rolling downhill, slow, then unstoppable. Year 1, you barely see it move. Year 20, it flattens everything in its path. $7,000 a year for 35 years at 10% becomes $1.9 million. The total contributions? $245,000. The rest is the boulder rolling. You do not need to earn more. You need the boulder to run longer. Start sooner. Starting at 25 versus 35, the difference is over $1 million at 65. This is where it gets really interesting. The 3-fund portfolio. Boring. Extremely effective. VTI covers the entire U.S. market, 3,600 companies in one fund. VEU adds international exposure. 49% of global market cap is outside the U.S. BNDW adds bonds. Stability when markets drop 30%. You won't panic, you'll hold. Diversification is not about owning more. It is about owning less of the wrong things. Morningstar data shows 3-fund portfolios outperform actively managed funds over 20 years. Over 20 years, over 90% of active funds underperform simple index ETFs. Yet people still pay 1 to 2% fees for underperformance. Every single year. But here's what nobody is telling you. The stealth wealth move isn't what you invest. It's what you don't spend. The person driving a 10-year-old car with $1 million portfolio is infinitely wealthier than the BMW leaser. Stealth wealth is not deprivation. It is allocating spend to what actually creates life satisfaction. Alex spent big to look wealthy. Jordan spent small to become wealthy. Different goals entirely. Vanguard research shows that a 30% savings rate produces financial independence in 30 years. A 50% savings rate reduces that to 17 years. The math is not linear, it accelerates. You think the stock market is the lever. It isn't. Your savings rate is the actual lever. A reversal. The problem isn't that you don't earn enough, you spend too close to your income. Family is a financial milestone. Ignoring parents' financial needs is not stealth wealth. It's short-sighted. Investing in a condo for an aging parent is also an asset. Dual-purpose planning, a North Star for your 40s. Without a vision, every financial decision is reactive, not strategic. In the next section, I'm going to give you the complete 9-milestone action system. Every number, no fluff. Milestone 1. Max your Roth IRA, $7,000 per year. Automated on payday. Every single year without exception. Hold VOO or VTI inside that Roth. Low cost, broad, and historically 10% annually. Let the Boulder roll. Above the income limit, use the backdoor Roth. 2 steps, fully legal, still tax-free at 65. Milestone 2. Protect the delta. Track every expense. Not to restrict, to be fully intentional about the gap. Every raise is a chance to widen the delta, not expand your lifestyle. Those two paths diverge permanently. Alex got a $20,000 raise at 36 and spent it all. Jordan invested it entirely. That $20,000 at 10% grows to $83,000 by the time Jordan turns 51. Milestone 3. Build 12 months of emergency fund, start with $1,000, ladder up deliberately. Park it in a high-yield savings account at 3+%. Your emergency fund should earn while it waits. 12 months of cushion means you never take a bad job out of desperation. That's real financial freedom. Milestone 4. Get your estate plan done, living will, healthcare POA, beneficiary designations updated. Online legal platforms make a basic will and POA accessible for under a few $100s. No excuse left. Even a single asset with an unclear title can cost families thousands in probate court. Do it now. Milestone 5. Add 1 income stream. Not 5, 1. Make it generate $500 per month minimum. $500 a month invested instead of spent is $6,000 a year. In 10 years at 10%, over $95,000. Dividends from SCHD reinvested automatically become the second boulder rolling alongside your Roth IRA. Milestone 6. Fund your family. A parent's housing is an investment. A monthly stipend is a plan. Wealth without family care is incomplete. The financial plan that ignores people is just a spreadsheet. Milestone 7. Housing. Run the rent vs buy math before sentiment decides for you. Use real numbers. The home buyer who skips the math walks into a 30-year financial commitment half blind. At 6.5%, a $500,000 mortgage costs roughly $3,100 per month. Total interest paid over 30 years on that loan, over $440,000 before taxes or maintenance. The question is not whether to buy. It's whether the numbers justify it versus your best alternative. Milestone 8. Health is wealth. The BLS data shows healthcare is the fastest rising lifetime expense. Fidelity projects the average 65-year-old couple will need $315,000 for healthcare alone. Preventive care is cheap. Emergency care is catastrophic. The choice is made daily, not once. If eligible, max your HSA. Triple tax advantage, contribution, growth, and withdrawal for healthcare are all tax-free. Milestone 9. Have a vision for your 40s. Where do you want to live? How do you want to work? Ask yourself, will my Thursdays in 7 years look like my Thursdays today? If you can't answer, that's the problem. Without a North Star, every financial decision is just noise. A clear vision turns chaos into a plan. A vision makes trade-offs obvious. You stop spending on what doesn't serve where you're going. Jordan built a 10-year financial and life vision at 32. Alex never did. Here's where they are now. Jordan's Roth IRA, $260,000. Emergency fund, fully funded at 12 months. Second income, active. Alex's Roth IRA, 31,000. Emergency fund, 1 month. Second income, none. Same exact salary as Jordan. The system is the difference. Not talent, not luck, not income. The system Jordan built and Alex didn't. You think the stock market is what creates wealth. Actually, it just stores the savings rate you already built. The Boulder, your compound interest, only keeps rolling if you keep pushing it, month after month, no breaks. Stop the contributions for even 3 years, and the compounding loss is not 3 years. It's exponential. The full 9 milestone stack runs simultaneously, compounds faster than any individual piece alone. Roth IRA feeds tax-free growth. Emergency fund protects it. Income streams accelerate it. Vision directs it all. The Federal Reserve data is brutal. Median retirement savings for Americans aged 55 to 64 is $134,000. $134,000 is not enough. At 4% withdrawal, that is $5,300 per year. That's not retirement. Jordan's trajectory at this point. $2 million portfolio target by 65. Fully on track. System intact. Alex's trajectory.